Today we're going to go over Chapter 18, the budgeting chapter. And this chapter is kind of a hard chapter to lecture on, but it's a very easy chapter to read on. The information that's in the chapter and in the budgets has to be given to you. And then all you have to do is just construct the budgets based off of the information given. So let me first start by telling you the master budget is a combination of every single budget, which is the sales budget, the production budget, materials budget, the labor budget, the overhead budget, the sales and administrative type budgets. So there's a whole bunch of budgets that go together, and businesses on an annual basis, and sometimes quarterly or semi-annual, prepare budgets to try and prepare for the future. So the first budget that drives every single budget is the sales budget. So I've written here what a typical sales budget should look like. It's very simple. Sales volume, what do you anticipate the sales volume to be? Now most businesses do it on a monthly basis, but you could do it quarterly, semi-annually, or annually. But most do it on a monthly basis. So they'd say, okay, for January, what do we anticipate our sales volume to be? Well, you go to the salespeople and to the accountants and you try and figure out what you think sales will be for that month. In your homework and in the chapter, this number has to be given to you. So in a word problem, they'd have to say, we anticipate sales volume to be, and they'll tell you. Same thing with the price. It has to be given to you. You can't just determine what the price is going to be on your own. You've got to figure out what the price is, and the problem will have to tell you that. So this chapter really is fairly simple. This information is given, typically in a word problem, and you just have to put it together. So sales volume times the price of each item would give us the revenue we plan on earning in that month or whatever the time frame is. Now, if you look in your textbook, they have an example of a sales budget on page 881. And you can see that there's a little bit more detailed because they then go to say, well, this is what would be on an income statement. This is the revenue that we've earned. But what about cash flow? Are we going to get all this in cash? Well, we know from Accounting 111 and Accounting 230 that revenue earned on our income statement is not going to be the cash that we get. All of these customers aren't going to pay us in this month. So that's why in this exhibit on the sales budget in the textbook, they then say, well, for example, 80% of this will be received in January. So you would say 80%, and that's the cash that will be received in January. The remaining 20% then would probably be received in the next month. The problem, once again, has to tell you that information. You wouldn't know that. They would have to tell you what percentage will be received in the current month and what percentage is going to be received in the future. So for example, if 80% was for this month, then the problem might say in the remaining 20% will be received in the following month, which would be February. So in February, if you want to know the cash flow, you'd have to take this 20% from January and then add the 80% from February. And then that would get you how much cash would be received in February. Okay, the next budget after the sales budget, once we've prepared this budget, is production. Now that we know what our sales are, how many of these items do we need to produce? Well, here is an example of a production budget. It's very simple. It just says, what's the sales volume? So you take your sales volume. See, that's why you have to do the sales budget first, because this information, as I said before, drives all the other budgets. So you take the sales volume for January or whatever month you're doing. Then you have to figure out what is my desired ending inventory. Because let's say you have 500 for sales volume. Is that how many you're going to produce? Do you want to have some left over at the end of the month to start the next month with? Of course you do. You want to have some inventory, a desired ending inventory at the end of January. So that's why you take your sales volume plus your desired ending inventory. The problem has to tell you what that is. Typically what they say is it's going to be a percentage of February's sales volume. So if they say, let's say February sales volume is 400. So if it says you want to have 20% in ending inventory of next month's sales, then you'd say, okay, well 20% of 400 is 80. So I want to have 80 in ending inventory at the end of January. So I can start February with 80 already there. So you take your sales volume that you anticipate plus your ending inventory gives you what you need. This is what you need. But we might have already had some in beginning inventory. So if you already have some in ending inventory, or I'm sorry, beginning inventory, you have to subtract those out. So then this would be the total you need to produce. The textbook has a very good example of this on page 880. On 882, where they're producing boats. So now they know, for example, in the first quarter, they do it quarterly, that they need to prepare 30 boats. Exhibit 3 is a direct materials budget. See, once we know how many we have to produce, now there's different materials that go into it. And unfortunately, for a boat, there's going to be such things as wood and fiberglass. So they're just saying there's two items, two materials. So they have to have two separate material budgets, because you have to do a budget for the wood, and then you have to do a budget for the fiberglass. You can't combine them. If your product has 5 different materials that go into it, then you have to have 5 different materials budgets. The materials budgets work the same way that the production budget works. What is our desired, but in this case, our desired units to produce, plus desired ending inventory minus beginning inventory would give us the total raw material that we will need to purchase. The next budget is the direct labor budget. This is Exhibit 4 in the textbook. It's very self-explanatory. I think you can see that you just take however many you're going to produce times the hourly rate would give you, however many you're going to produce times the standard hours, the number of hours needed to make that boat, and then multiply that by the cost per boat, the labor cost per hour. I'm sorry, I said that wrong. The labor cost per hour to manufacture the boat. And then the next 2 budgets are Schedule 5 and 6. Schedule 5 is the manufacturing overhead, and 6 is the, not 6, it's 7, is the selling and administrative budget. So it's Exhibit 5 and Exhibit 7. They work in the same way. For Exhibit 5, they say this is the overhead budget, and they divide it up between variable overhead and fixed overhead. The variable overhead, you just have to figure out, how am I going to allocate these variable overhead costs? Well, they have to give you the variable overhead costs. And in this example, they're doing it by hours, 2,400 hours times the variable overhead cost per hour for each item, indirect materials, indirect labor, utilities. And then the fixed manufacturing overhead costs, they just tell you what the fixed costs are. And in this case, it's per quarter. So then you just plug in every quarter the exact same fixed overhead costs. At the bottom, let me point something out here. It says total manufacturing overhead costs, and in quarter 1 it says 60,000. Okay, that 60,000 would be on your income statement less depreciation. They're subtracting out the depreciation they just added in. Why are they subtracting out that depreciation? Because depreciation is a non-cash item. So if you wanted cash flow information, you have to subtract that back out. So for cash flow purposes, the total overhead would be 45,000. So on a cash flow statement, it would be 45,000. On an income statement for quarter 1, the overhead cost would be 60,000. Okay? So that's pretty much it. This is the chapter. Your homework problem is going to have you preparing almost every single one of these budgets. So you need to make sure that you go through all these budgets in detail and that you understand how they work. Once again, the information's given. All the information's given, you just have to put it in the right format. On a test, you will have to know that format. It will not be given for you. So make sure you understand it. But once again, once you understand this overhead stuff, it makes perfect sense. It really makes perfect sense. You just have to make sure that you understand what's happening, and then when the information's given, you just kind of plug it in. All right, good luck with this chapter, and I will talk to you soon.